Welcome back to the deep dive. We've been getting a ton of questions lately, all about business funding. And honestly, it's no surprise, right? I mean, trying to figure out all those options, it can feel like you're lost in some kind of crazy financial jungle.
Yeah, it's a real maze out there.
So, we're going to try and clear a path for you today. We're going to break down some of the most important stuff we've been seeing, from the stuff you guys have sent us. And we're really going to zoom in on one particular method that's been getting a lot of buzz factoring.
Exactly.
We're going to compare it head to head with, the traditional loans and asset-based lending. And we really want you to walk away from this deep dive with solid grasp on which of these options could be like your secret weapon at each stage of your company's growth.
Yeah, it's so easy to get caught up in all those interest rate comparisons and the tiny details of, loan
Oh,
terms.
absolutely.
But what's really important is understanding how to actually get your hands on that money, how to access that capital, and how these different methods can actually fuel your growth at different points in your journey.
For sure.
So to kick things off, it's really crucial to, grasp this one key point when we talk about how much funding you might qualify for, or even more importantly, how much you can actually get. Well, that depends on a whole bunch of factors specific to your business. Things like how long you've been around, how much revenue you're bringing in, and just your overall, financial health.
Right. Yeah. Like every business has its own unique financial fingerprint, I guess you could say.
Exactly.
Okay. So to keep things apples to apples, we're going to use a hypothetical funding need of $1 million throughout this whole discussion, just to give us a consistent baseline for all these comparisons. All right. Let's dive in. And let's start with what might be a brand new concept for some of you: factoring.
Okay.
What exactly is factoring? Can you give us a breakdown?
Okay, so picture this. You've sent out invoices,
All right.
right? You've done the work. You're waiting to get paid.
Mm.
But your customers, well, they're taking their sweet time sending you that money.
Right. Yeah.
Factoring is like a way to hit that fast forward button on your receivables. So instead of twiddling your thumbs and waiting 30, 60, even 90 days for those payments to trickle in, a factoring company steps in. They give you a big chunk of that invoice value up front, like right now.
Okay. So it's basically like getting paid early.
Exactly.
That sounds pretty handy. But let's get down to brass tacks. Who can actually qualify for this? Is there a hidden catch we should know about?
Well, here's where things get really interesting. And this is a big difference from traditional loans. You see, with a bank loan, they're laser focused on your business's credit history,
Right.
how long you've been operating, all that jazz. But with factoring, it's a whole different ballgame. Qualification mainly hinges on the creditworthiness of your customers.
Oh, interesting.
So the companies who owe you money, it's all about their ability to pay up.
So basically, if you have solid customers, you're good to go.
Yeah, pretty much.
Yeah.
And what's amazing about this is that even a super new business, maybe just a month old, with invoices from, reliable, creditworthy customers, they could potentially tap into funding through factoring.
Wow. I mean, that sounds like a total game changer, especially for startups who are just starting out and, might not have that long credit history yet.
It really is.
And it makes sense, right? If a business is, making more sales, sending out more invoices, their access to funding through factoring would just naturally grow along with them.
You got it. Factoring is, at its core, super scalable.
Okay.
It's directly tied to your invoice volume. So as your business takes off, as you generate more and more receivables, your funding capacity through factoring just extends right along with you. It's dynamic.
Yeah.
It adapts. It's not like some rigid, fixed thing.
Okay, that makes a lot of sense. And so typically, how much of that invoice value can a business expect to get up front?
Well, usually you're looking at an advance of somewhere between 80 and 90%. So a pretty substantial chunk of that money right off the bat. And then once your customer settles that invoice, the factoring company sends you the rest, minus their fees, of course.
Okay, cool. So let's really focus on those super early days, the startup
Yeah.
phase, maybe that first year, year and a half of operation. We've touched on this a bit, but it seems like factoring could be especially critical during that period.
Oh, absolutely.
Why is that?
The big advantage for startups, as we've said, is that potential to get qualified super fast. You might only need 1 month, just 1 month of invoicing history to be eligible.
Wow.
Think about that.
Yeah.
Your access to funding isn't chained to, maybe a non-existent company credit history or how many years you've been in business. It all boils down to the quality of your sales.
Hmm.
and how likely your customers are to pay their bills on time.
Okay. So I'm trying to really visualize this. Let's say we have a brand new company, just 1 month in, but they've already managed to rack up like $125,000 in monthly invoices. What would their funding options typically look like at that point?
Okay, so in that scenario, trying to get a traditional loan, well, let's be real, it's probably not going to happen.
Right.
They just haven't had the time to build up that, credit profile that banks are so obsessed with.
Makes sense.
And then there's asset-based lending. That's where you use your company's assets as collateral, things like equipment or inventory. But again, for a fresh out of the oven company, they probably haven't had time to accumulate a lot of assets yet.
Right.
So that path might be a bit tricky too.
So where does that leave them?
But factoring, now that's a different story. With those $125,000 in invoices, boom, they could potentially get their hands on something like $100,000 immediately. That's that 80% advance we talked about.
What?
And if their sales stay consistent, keep chugging along at that rate, well, we're potentially talking about an annual funding capacity that could exceed $1.2 million.
For a brand new business, that's a huge injection of working capital.
Yeah, it can be a real lifesaver.
What about the costs involved with factoring at this stage? For a startup in that early phase.
Okay, so based on what we've seen, the annual cost might land somewhere around $37,500.
Yeah.
If we're assuming a fee of, say, 2.5% for every 90 days. Now, I know at first glance that might seem like a lot.
Yeah.
But here's the thing. You got to compare that to the alternative.
Right.
What if they can't qualify for any other type of substantial funding? That could really stifle their growth. Or, worse, even their ability to just keep the lights on.
Right. So it's all about, weighing the costs and benefits.
Exactly.
Okay, let's shift gears a bit. Imagine our hypothetical business has, made it through those initial hurdles, and they're now moving into that exciting growth phase. Maybe they're like 18 months to 3 years in. How does factoring, continue to fit into the picture at that point?
Well, in this phase, the beauty of factoring really shines through in its ability to, effortlessly scale with the business.
Come on.
As their sales go up, the funding available through factoring just, grows right alongside them.
Yeah.
Automatically.
So they're not constantly having to go back and renegotiate.
Nope. No need to go through all those, time-consuming renegotiations every time they land a big new client or, their sales jump up. It just adapts.
Interesting.
And, another big thing here is how factoring can really help them keep their cash flow in sync with their business operations.
I see, yeah.
They're not, sitting around waiting for those customer payments to show up weeks or months later while still having to, cover all their immediate costs.
Makes sense. Okay, so let's run another comparison here. Let's say we have a 2-year-old business that's pulling in about $1.5 million in annual revenue. What might their funding landscape look like across these 3 different options?
Okay, so let's start with the traditional loan route. They might be able to snag a line of credit for, let's say, $500,000. But the reality is they probably won't be able to actually access that full amount.
Right.
More likely, they'll be able to draw down somewhere between, $300,000 to $400,000 of that.
Okay.
The annual cost for that could be around $36,000. But that pesky hurdle of limited business history, well, that's probably still going to be a factor.
Right.
Now, asset-based lending, that might give them a slightly bigger line of credit for $600,000. And their actual access might be in the $350,000 to $450,000 ballpark. But we're looking at a potentially steeper annual cost here. Could be up around $78,000.
Wow.
And
Yeah.
then, of course, they'd have to, prove the value of their assets, maybe even go through some regular audits.
That's a lot of hoops to jump through.
Yeah. Now, with factoring, if this business is bringing in $125,000 in monthly invoices, which lines up with that $1.5 million annual revenue, they could still get immediate access to roughly $100,000. So that translates to that same potential annual capacity we talked about before, over $1.2 million. And the annual cost, well, it'd be similar to that traditional loan, somewhere around $37,500.
Okay.
But the real differentiator here, it still all comes back to qualification. It's mainly about their customer's credit.
So even as a business, matures, becomes more established, that accessibility that factoring offers, it seems to be a real consistent advantage.
Yeah, it is.
Okay, so what happens when a business is truly established? They've been around for 3 years or more.
Okay.
Does factoring still have a place in their toolkit? Or is it better suited for those earlier stages.
It definitely still has a place.
Okay.
In fact, established businesses, they might even find that they can negotiate better rates with factoring companies
Yeah.
because they've got that consistent volume of sales and a solid payment history.
Hmm.
It's like they've earned their stripes.
Right.
And, it still offers that essential flexibility, especially if they're going through a period of like super fast growth or expansion. It can work really well alongside any other financing they already have in place. And it's especially helpful for businesses that have to deal with those long customer payment cycles, you know, where they have to wait 60 or 90 days to get paid.
Yeah, for sure.
It can really put a strain on their working capital if they don't have a way to bridge that gap.
Right, okay. So let's bump up our example a bit. Imagine a 5-year-old company, nice and established, with, let's say, $5 million in annual revenue. How would those three funding options typically stack up at that stage?
All right, well, with a traditional loan at this point, they might qualify for that full $1 million we've been talking about.
Okay.
But realistically, their actual access might be more like, $700,000 to
Yeah.
$800,000.
Yeah.
And we're probably looking at an annual cost of around $74,000. But it's still a fixed funding limit. It's not going to budge beyond that.
Right.
Now, asset-based lending, that might also put a $1 million line within reach.
Okay.
But again, their actual access might be similar to the traditional loan, somewhere in that like $650,000 to $800,000 range.
Huh?
The annual cost, though, could be quite a bit higher, maybe even around $119,500.
Ooh.
And as always with asset-based lending, they're limited by the value of their assets. Now, factoring for a business with, let's say, $400,000 in monthly invoices, which would put them right around that $5 million annual revenue mark, that could give them immediate access to something like $320,000.
Wow.
So that's a potential annual funding capacity of over $3.8 million. Now, the annual cost might be around $96,000, but, and this is a big but, there's no fixed ceiling on how much they can access. As their sales climb, their funding can keep pace.
Right, it grows with them.
Exactly.
Okay, so it really seems like across all these different stages of growth, factoring offers this like unique type of access to capital. Can we kind of sum up some of the key advantages that factoring brings to the table compared to, those more traditional methods?
Absolutely. So one of the most striking things is how much faster you can get your hands on the money with factoring. I mean, we're often talking 3 to 5 days. That's it.
Wow.
Traditional loans and asset-based lending, well, get ready to wait. We're talking 30 to 90 days sometimes. That's a huge difference, especially when you need that cash flow like yesterday.
Right. Time is money.
Exactly. And then, of course, there's that whole ease of qualification thing we've been talking about.
Right.
Factoring, they're looking at your customer's credit. The other guys, they're digging deep into your business's financial history and your asset base. And let's not forget how well factoring aligns with growth. As your sales go up, your funding through factoring just automatically increases. No need to renegotiate, no fixed limits.
Yeah. It's like inherently flexible.
It is. And then lastly, that instant conversion of sales into cash flow, I mean, that's a game changer. It directly boosts your working capital, lets you keep things moving.
Yeah, you're not waiting around for those payments to come in. Okay, so we've talked about the cost throughout this discussion, but I think it's worth like really zeroing in on that for a minute.
Yeah.
Because that's often the biggest concern for businesses.
Right. So I get it. You look at the rate, the fees for factoring, and at first it might seem like it's more expensive than, the interest you'd pay on a traditional loan.
Right.
But here's the thing. You have to remember what we talked about earlier. It all comes down to how much capital you can actually access.
Mm-hmm.
So, sure, a traditional loan might have a lower interest rate on paper. But what good is that if you can't even qualify for the full amount you need, or if you're stuck waiting forever for them to approve it?
Right. Yeah. It's like a theoretical low cost if you can't actually get it.
Exactly. And asset-based loans, they come with their own baggage. You've got fees for appraisals, for ongoing monitoring, all that stuff. But with factoring, even if that percentage fee looks a bit higher up front, you're getting that money fast. And often you're able to access more of it. So that can actually translate into a better overall return on your investment because you have that cash on hand to operate, fulfill orders, and go after those growth opportunities.
Right. You're not missing out on, potential deals or contracts just because you're waiting on funding.
Exactly.
Okay, this is all great, but let's make this like super tangible,
Okay.
Our sources actually highlighted a few real-world success stories of businesses using factoring at different stages. Can you walk us through a couple of those?
Yeah, absolutely. So there was this one startup, a manufacturing company, they landed this huge contract, $1.5 million,
Wow.
but they needed to buy raw materials,
Yeah.
and they were brand new. Basically, no business credit history,
Oh, so traditional lending was out.
totally off the table. But they factored their first invoice for $150,000, and bam, they got $120,000 in cash, like right away. They were able to fulfill that contract without having to, give up equity or delay production.
Yeah, that's a great example of how factoring can really unlock those doors, those opportunities that might otherwise be totally out of reach.
Yeah.
What about for a company in that like crucial growth phase?
All right. So we came across this 2-year-old service company. They were on fire, growing like 15% every single month.
Oh,
But their customers were killing their cash flow, these 60-day payment terms.
ouch.
So they started factoring their monthly invoices, which were about $200,000, and that consistently gave them access to $160,000 every month. Boom, fuel for their growth. And they didn't have to take on any long-term debt.
Okay. And what about like an older, more established business?
There was this 5-year-old distribution company. They were doing really well, had a solid financial track record,
Okay.
but they had this peak season where their orders just exploded, way beyond what their regular credit line could handle.
So they needed a way to bridge that gap.
Exactly.
Yeah.
Factoring gave them that extra working capital they needed to keep up with those orders. And they were smart about it. They only used it when they absolutely needed it, so they were able to optimize their financing costs and stay flexible throughout the year.
So it sounds like the real, winning strategy isn't necessarily picking one of these options and sticking with it. It's more about like strategically blending them together, tailoring your approach to, your business's unique needs and where it is in its life cycle.
That's exactly it.
So for our listeners out there, as we wrap this up, what's the like one big takeaway you want them to walk away with from our deep dive into all these funding options?
The big takeaway is that factoring offers some really powerful advantages. And those advantages, they actually apply to every stage of a business's development.
Oh,
For startups, it might be the only way they can get their hands on a meaningful chunk of funding right away. For companies that are in that growth mode, it gives them a way to access funding that scales directly with their success. And for those established businesses, it adds this really crucial element of flexibility and can perfectly complement any other financing strategies they've already got in place. The thing is, when you're trying to decide what type of funding is right for you, don't just get hung up on those little differences in interest rates. Focus on the bigger picture. How much money can you actually get access to, and how fast can you get it? At the end of the day, that's what matters. And when it comes to that, factoring consistently delivers.
this has been such a great deep dive. We've really gotten into the nitty-gritty of business funding today, and I think we've shown a light on factoring, which is often, overlooked but super powerful. So, listeners, here's something to chew on. Think about a business, maybe even your own future ventures. How could they use factoring strategically, maybe even before they consider those traditional funding methods? Could it be a way to, supercharge their growth and really get a handle on their cash flow? It's a question worth exploring.
Yeah, I think so.
We always encourage you guys to, take a deep dive into your own situation and really research these options. And hey, thanks for joining us for this episode of The Deep Dive.